Planning for retirement income is a serious and complex issue. If you do not plan properly, the risk of you outliving your money is very, very real. In this episode, I am going to discuss what strategy you can adopt so that you will not run out of your money during your retirement years. This is Dr. Chandrakant Bhatt, investment consultant and a financial planner for NRI Money Clinic.
NRI Money Clinic. No hype, just the right advice.
As I said, planning for retirement income is a very complex issue. The only thing which is certain during retirement years is that you don't have an active income. In lieu of an active income which was coming by way of your salaries or other sources of income, we need to replace it with an income that you have created during your retirement years. What are the complexities? The complexities which are unfolding as of now are the possibility of low interest rates that will come in 5, 10, 15, 20 years from now. There is a risk of inflation. We do notice that the inflation is coming down, but nevertheless, however less the inflation could be, but inflation is also an issue. You as an individual is growing older. There are problems which are associated with your health. There are problems which are associated with your memory. The rising cost of health insurance is one another thing which bothers you. Look at the pension rates. The pension rate is coming down in line with the falling interest rates. So what shall we do? How shall we plan for a proper retirement strategy so that we will not have any problem of running out of cash during our retirement years? Let's look at the options with us. Any strategy that we are going to adopt to create retirement income should have two major components built into it. One, the income that we are going to derive should be inflation proof. That means when the inflation catches up, the cash flow that you are planning to have should also rise simultaneously. This is called inflation proofing. The other aspect is we should also have stability of income. In our pursuit of beating the inflation, if we create volatility in the assets that we have in your retirement income, that can backfire. So while inflation beating is very, very important, it is equally required that you should have stability of income. Now let us see what are the instruments which are available and how we can strike a balance using these instruments to beat both inflation as well as to create a stable income. The first instrument which is available for us to create a retirement income is rental real estate. A rental real estate is a fantastic retirement income creator for you. The rents of a property are inflation proof. When inflation rises, the rents that you get from these properties will automatically rise. When the property rentals increase, obviously the property prices will also increase. Tomorrow, sometime in distant future when you retire, if you run out of the cash or the rentals are not sufficient for you or the other sources of income are not sufficient for you, you also have the rising value of the real estate which you can liquidate and use for whatever the purpose you might be needing. This is the positives of rental real estate. What is the negatives of a rental real estate? The negatives of a rental real estate is you may or may not have a tenant. While you can count on the rental income, suppose if you don't have a tenant, it can create a dry periods for you. Likewise, the tradability of your property, that means the real estate is actually an illiquid asset. Tomorrow, if there are no buyers for your property, if you want to liquidate, you may find some problem with that. There is one another problem with the rental real estate. If you are already a retired person, now you can't use your retirement income or the corpus to go and buy a property and create an income out of it. If you are a retired person, don't try to buy a property and try to create some income out of it. But if you are a person in your early career or if you are in the middle of your career, say 45, 50 years of age, probably it makes sense for you to invest in some rental real estate which can give you good cash flows for many, many years to come. The one another problem of rental real estate is it calls for huge sums of money for you to buy the rental real estate. Yes, rental real estate is an excellent inflation beater, but the negatives are also comes as a package in a rental real estate. So before you venture into buying a real estate, make sure it fits your bill properly. The second asset class or the instrument that is available for us to plan retirement income for you would be a well constructed mutual fund portfolio. I stress the word well constructed mutual fund portfolio. It should not be risky, it should be constructed in a very scientific manner. The volatility has to be reduced. What are the advantages of a mutual fund portfolio? The real advantage of a mutual fund portfolio is again it is inflation proof. In the short term, anything can happen in the valuation of mutual funds. But over longer periods of time, it's obvious that the mutual fund portfolio will give you an inflation beating return. There are other advantages. A mutual fund is a liquid instrument. You can divide this. You don't have to sell the entire portfolio to generate an income. You can only take out so much. It does not have a contract which is built around it. You can put in any amount of money. You can take out any amount of money. You can create an income that you need by way of a systematic withdrawal plan. All these advantages will come to you through a creation of a mutual fund portfolio. What is the negative of a mutual fund portfolio? The negatives of a mutual fund portfolio are the prices can be very volatile. Unless you have long time horizon in your mind, it cannot work in short term unless it's a debt fund. If it's a debt fund, it will not beat inflation. To beat inflation, a certain amount of equity has to get into your mutual fund portfolio. While mutual fund portfolio is a good inflation beater, but its problems comes from volatility and needing long term to deliver the returns. While rental real estate and mutual fund portfolios can give you inflation beating returns, but they cannot cater to you for a guaranteed rate of return or a stable return they cannot create. The returns they can create can vary. So what shall we do to create a stable return? One answer lies in putting your money into the fixed deposits. Fixed deposits will assure you a guaranteed rate of return as per the contract that you get into. While this is the positives, likewise the fixed deposit is very liquid. You can walk into a bank branch, pay that 1% penalty or whatever the penalty, you can pre-close it. You can do a fixed deposit by taking interest on a monthly, quarterly, yearly basis as per your requirement. This is the positives. What is the negative side of the fixed deposit? The negative side of the fixed deposit is if you have kept a large amount of money as fixed deposits, the interest that you derive from fixed deposits will come under taxation. Now think about a retirement scenario where you have a couple of crores of rupees as bank fixed deposit. Whether you consume this money or not, the interest that you get from the fixed deposit is treated as your income, and if you are a taxpayer, you have to pay taxes on this interest that you are getting. Taxation is a burden when it comes to the question of fixed deposits. Likewise, there is one another thing which is unfolding. In one of the videos earlier, I had told you, are the low interest rates are here to stay. In my personal opinion, over the years, the interest rates will keep falling down. If you depend only on fixed deposit, you run the risk of having a lot of money, but it hardly generates any sizable amount of cash flows for you. Falling interest rate is a risk that you are carrying with the fixed deposits. While fixed deposits are good instruments to guarantee you a stable income for you because of its taxation and because of its low interest rate which might unfold in years, there is a negative which has crept in. How can we solve this particular problem? The answer to this question lies in subscribing for pensions or subscribing for guaranteed return income plans from the insurance companies. Both these instruments, the pensions that you get as well as the guaranteed income plans from insurance companies, will ensure that you have a stable income throughout your life. This is the good part of a pension and a guaranteed income plan. What is the negative? The negative is the moment you subscribe to a pension plan or to a guaranteed income product of an insurance company, the cash flow beyond that particular point will not rise. Let's say that you have locked in these pensions for your entire life, or from insurance company, the guaranteed income plans which give you guarantees for 25-30 years, your cash flow remains same, but over a period of time, inflation slowly but steadily picks up, which only means to say the cash flow, whatever you are going to get, will lose its purchasing value over a period of time. So while pensions and guaranteed return plans of insurance companies give you stability of income, they will not beat inflation, and over longer periods of time, they can eat into the purchase value of your cash flows. One another problem with pension products is pensions can come under taxation. If you are a person who is having a very small income, less than the taxable slabs, is fine. But if you are a person who is having a large income during your retirement years, you may be having rentals, you may be getting interest from the bank fixed deposit or from some of the government schemes, or there could be other sources of income. The pension that you get gets added to your income and it can come under taxation. While the pension you receive itself is smaller, paying for the taxes can really bring down its efficiency. Whereas the guaranteed income plans from insurance companies, as things stand today, are 100% tax free. You can subscribe to these guaranteed income plans from insurance companies if you are only less than the age of 60 years of age. If you are a person who has already retired, you do not have the luxury of buying into guaranteed income plans from an insurance company which are tax free. Apart from the instruments, whatever I discussed till now, there are other instruments which are also available. For example, you can get dividend from the stocks, or you may have an opportunity to invest in governmental schemes like RBI bonds or some bonds or Pradhan Mantri Vaya Vandan Yojana or senior citizen savings scheme or post office schemes or debt funds of the mutual funds. By their nature, they come into fixed income instruments. So whatever the discussions we had with respect to bank fixed deposits or with respect to pension will also apply to them. Till now, we saw all the instruments that are available for us to create a retirement income. And unfortunately, none of these can cater to all the requirements of retirement years. So how do we create a proper strategy to have all things in one particular place? For that, you need the help of a financial planner. If you want to use our services to create a proper retirement income for you, our services are always available to you. I have shown the number here on the screens. You can reach out to us through a WhatsApp message, and either myself or one of my team members will help you to design a proper retirement strategy. Feel free to contact us from any part of the world. Dear viewers, now how shall we create a best investment strategy for you so that you will have a stable as well as an inflation beating returns during your retirement years? Answer to these questions lies in not subscribing to any one single particular plan. Whatever you do, whichever the way you plan it out, one single instrument will not cater to your requirement. An ideal strategy should have 4 different things in a retirement planning. What are the 4 things? These are the same 4 instruments what I discussed. A rental real estate, a mutual fund portfolio, a fixed deposits, and a guaranteed return income plan from insurance company or a pension plan. When you have all the 4 in your portfolio, then only you can feel happy and feel secure that you have designed a good retirement strategy to give you cash flow during your retirement years. We only wish you design the strategy properly and you have your golden years as you have planned. Dear viewers, by watching this video, if you got some insights into how to design a strategy to create a retirement income, please like this video. If you are a person who is watching this channel for the first time, or if you are yet to subscribe for this channel, please hit the subscribe button and press the bell icon. Don't forget to share this video with your near and dear ones. Thank you very much for watching this episode on NRI Money Clinic. I will be back with you with yet another topic in yet another video very soon.
Press the bell icon for more details and subscribe our channel.